Hello everyone, welcome to the Accounting and Finance Academy. Today I am going to start a very relevant topic for higher secondary and BCom students, that is accounting of share capital. Before going into deep of this particular topic, let me tell you that for the different forms of business organizations, there are basically 5 different forms of business organization. 1, sole proprietorship business. 2, partnership business. 3, company form business. 4, cooperative societies. 5, MNCs. Right now our discussion will be primarily on the company form of business organization. Now why this is important, right? So why we need to account for the share capital? See, in a company form of business organization, capital is actually contributed by a large group of people whom we call the share capital, right? And who are the owners of the company. But what happened, they don't directly participate in the management of the company. Instead, they will elect a board of directors as their representative to manage the affairs of the company. And in India, previously the Companies Act was 1956, now it is 2013. Okay, now just giving the small background of the company, let me start with a simple question: how we are going to define a company, right? If I have to say the company is an association of person who contribute money or money's worth to a common inventory and use it for a common purpose. So what happened? Company is an association person, is a group of several people who contribute money for a common purpose of earning profit. Apart from this, another point that is associated with the company is that company is an artificial person. Now when I'm talking about the artificial person, it means that the person which is not natural person like us, right? Now why we are calling company as an artificial person? Because the company is born by an act and also die by an act. As the company is not a natural person, so we need a common seal for its signature, because company can't sign in the document, so we need for signature we need common seal. So this is simple way to understand company is an artificial person and is an association of several persons who contribute money or money's worth for a common purpose of earning profit. Having discussed the meaning of company, let's see what are the features of a company. So there are different features, but primarily here I have mentioned some of the features, like body corporate. Now previously, as I told, that company is an artificial person, right? A company is formed according to the provision of the Companies Act 2013 or the law enforced from time to time. In India, companies are formed and registered under the companies law, except for some of the business organization like banking and insurance companies, for which we have a separate law, right? Next one is your separate legal entity. Now company has a separate legal entity which is totally different from its members. Now for example, I am shareholder of a company, my entity and the entity as a company is different, right? It can hold and deal with any type of property, so that is why it is called as a person. I am an individual, I have my own property. Company, being an artificial person, is having can hold and deal different types of property. Moreover, a company can open a bank account in its name, as it is an artificial person. Next one is your limited liability. Now for company form business, the liability of its members are totally limited. Now what happened? For example, why it is so? I have invested some money in a company, so I am the owner of the company. Now if something happens to the company tomorrow, and because of this the company is going to wind up, in that case I am not liable to pay any any further amount, because I have already paid the amount right, amount. So what happened in this case, the company can't tell me that okay, you need to sell the property to give the money to the creditors. The company can't sell like this. Now for example, if you have started a business and you are sole proprietorship business, so if tomorrow something happens to your business, you need to sell your own property to pay off the liability. That is not applicable in case of your company form of business. Then another one is a perpetual succession. Now what happen in case of your company form of business? A company is an artificial person created by law and continues to exist irrespective of the change in its membership. Right. Now what happen if the members are changing? Okay, it is not that a member will continue to your company throughout the life. Sometimes there will be change in the membership. There will be death or insolvency of any member, but this is not going to affect the company from its running, right? So the company will run for a long period of time. Next is your common seal. Now what happen, as a natural person I can sign on a document, but how the company will sign, because company is not a natural person, right? So the company being an artificial person cannot sign its name by itself. Therefore every company is required to have its own seal which act as official signature of the company. So these are some of the features of companies. Apart from this, there are so many other features. For your understanding, you can refer any book. Now what are the different types of companies? There are different way to classify the company, but here we'll see that the different types of companies based on two criteria. One is on the basis of liability, another one is on the basis of number of members. Starting with on the basis of liability, the first one is companies limited by shares. In this case, the liability of the members of a company are limited to the extent to the nominal value of the shares held by them. If I'm the member of a company, so I paid a certain amount and full amount of shares, then this is then there is no liability on part of its whatsoever may be for the debts of a company, right? I am not going to pay a single penny out of my own pocket anymore, or by selling any property I am not going to give a single rupee to the company to pay off the liability. This one is your company is limited by shares. The company is limited by guarantee. Now what happened in this case, the liability of its member is limited to the amount they undertake to contribute in the event of the company being owned up. Now what happened in this type of company, the liability of members will arise only in the event of its winding up. I have invested a certain sum of money in the company, but what happened, there is an agreement between there is an agreement in the document that in case of your winding up of a company, if need arises, then I need to pay some more money to pay off the liability. That is why company is limited by guarantee. The last one is your unlimited companies. Now when there is no limit on the liability of its member, this is called your unlimited company, right? Now when the company's property is not sufficient to pay off its debts, the private property of its members can be used for its purpose. This is not applicable in this companies limited by shares. Here, as the liability of members are unlimited, so what happen? You need to sell your own property if the company is not in a position to pay off the liability. This is your unlimited companies. Starting with the second category to classify the company is on the basis of number of members. On the basis of number of members, I will classify private, public company. So what happen in case of a private company? According to the articles of association of a company, a private company must have at least 2 persons or 2 members, and the maximum number of members can be 200 members. And here in this type of company, there is no there is a restriction to transfer the shares in the name of another members. This is your private company. But when all these things are not applicable, this will be called as a public company, right? Apart from this, there is another type of company known as one-person company. Now, what happened in case of a one-person company? Means one-person company means a company which has only one members. Now, this definition is according to the Companies Act 2013. So these are the different types of companies. Having discussed about the company, let me start with the share capital. Now, what happen if you are a single person or sole proprietorship business? You can arrange your own capital. But what happen in case of your company form of business, right? A company, as several times I mentioned the point that company is an artificial person. As it is an artificial person, cannot generate its own capital, which has necessarily to be collected from several persons. So what happened, there are so many people, so all the people are actually contributing some money that means that we can call as a capital, right? Now the person who are investing in the company are known as your shareholders, and the amount contributed by them will be called as a share capital. Now, what happened in the company form business, the number of shares is very, very large. So think of the TCS, the shareholders of TCS is large, right? Now, as it is large, a separate capital account cannot be opened for each for them. For example, in TCS, Mr. A, Mr. B, Mr. C has invested some money. So you can't open, okay, S capital, B's capital, C's capital. It is not possible, right? So here what happened? We are going to merge the contribution of all the members in a common capital that is known as your share capital. Yeah. So this is what share capital means. Just remember this one. Now let's understand what are the different types of share capital. Primarily there are several types of share capital. 7 of the share capitals I mentioned. Let me start with one by one. Authorized, nominal and registered capital. So all these are same. What happened in case of your authorized capital? According to the memorandum association of a company, there is one clause which is known as your share capital. That means you need to register your companies with certain amount. For example, you have registered your company with 5,000 crores. That means the maximum amount that you can raise from the public is 5,000 crores. So if you want to, depending on the requirement, I would say that if you want more money, then you need to change the clause, and accordingly you can raise money, higher than the authorized capital. That means by changing the law. Once it is authorized capital, the next one is your issued capital, right? So what happened? Authorized capital is fixed. Now 5,000 crores, to what extent I want? For example, I want out of 5,000 crores, I am issuing 2,000 crores to the public for subscription, right? This is your issued capital. Now company, it is so that company may not raise all the money 5,000 crores at a time, because the requirement of the company will be different. When there will be requirement, they will raise money. So the amount of authorized capital issued to the proportion of authorized capital issued to the public is known as your issued capital. So here, say for example, I have issued 2,000 crores capital, and I'm asking the investors to subscribe. It is not necessary that all the investors will subscribe. Means all the investors means the full 2,000 crores will be subscribed. Now out of 2,000 crores, there is a possibility that 3,000 crores people have subscribed. So it is a possibility that is known as your above subscription. Just the reverse is that out of 2000 crores, only 1500 crores subscribed in the company. That is known as your under subscription. So once the issued capital, you are telling to your shareholders that invest this much money, but the extent to which investors has actually invested in your money or subscribed the capital is known as your subscribed capital. Once subscription is done, that will be called as your called up capital. Now it is that part of subscribed capital which has been called up for shares. Say for example, say the face value of a company share is 100 rupees, right? So I am not calling the shareholders to give me full amount of 100 rupees. I am telling that okay, give me 50 rupees now. So my called up capital will be 50 rupees. This is the called up capital. Now as in this case, I asked my investors to give me 50 rupees. The possibility is that the investors won't pay the full money, 50 rupees, right? So what happened, they have given, say for example, 30 rupees. This 30 rupees will be called as your paid up capital. So what is paid up capital? Paid up capital is nothing but the proportion or the amount of called up capital that investors has given to the company. Then your uncalled capital. Uncalled capital means that portion of subscribed capital which has not yet been called for. So here the company has called for 50 called up capital is 50 rupees. The total amount is 100 rupees. The total amount of share capital is 100 rupees. Out of 100 rupees, companies call for 50 rupees. The remaining 50 rupees will be called as the uncalled capital. Okay. After uncalled capital, the next one is your reserve capital. Now what happened? A company may reserve a proportion or a portion of its uncalled capital to be called only in the event of the winding up of a company. That means here it is 50 rupees is my uncalled capital. So I'm keeping, say for example, 25 rupees as the reserve capital. So this reserve capital will be fixed in a company. I'll ask my investors to give at the winding up of a company. This is the reserve capital. So these are the different types of share capital. Now I will talk about the types of shares. So primarily there are basically two different types of share. One is your equity shares, another one is your preference shares. Now what is equity shares? Equity shares are those shares which do not enjoy any sort of benefit. Now what are the different benefits? The benefits is in terms of dividend, and the second one is that in terms of at the repayment of capital during your winding up of a company. So as they don't get any sort of benefit from the company, that is why it is known as your ordinary shares or equity shares. Now the next one is your preference shares. So what happened in this case, as they are not getting any sort of benefit, but what happened, they will actively participate in the management of the company, because as in case of a company form of business, we need to appoint or elect board of members. So here what happened, they will actively participate to whom to be elected to sit on the board of directors. So that is what they get the voting rights to elect the persons who will manage the company. The second one is that your preference shares. Now preference shares will get some rights. These rights there are basically two different types of rights compared to your equity shares. What the different rights they get? The rights in terms of getting dividend, number one. Number two, at the repayment of capital at the winding up of company. So they get these two preferences compared to equity shares. That is why these shares are known as your preference shares. There are different sub classification of preference shares. I'm not going into that level right now. Now, issue of shares. So you need to follow, or company needs to follow different steps to issue share capital. Number one is your issue of prospectus. The company needs to issue the prospectus to the public. Now what is prospectus? Prospectus is basically an invitation to the public that a new company has come into existence and it needs funds for doing business. It is kind of invitation. Now when you are inviting the general people, they will come and invest in your company. So once you have invited your invited public for investing in your company, so after that you will receive the application. As after, when the prospectus is issued to the public, prospective investors intending to subscribe the share capital of the company would make an application along with a money which we call as an application money. Now what happened, once you have shareholders or investors applied, it means that there will be two situations. Situation one is that your over subscription, another situation will be called as your under subscription. Over subscription means you are telling that okay, I need means 1000 rupees, and for this I am actually issuing 10 shares. Now 10 shares at the rate of rupees 100. But what happened, 30 investors have come to invest in your company. So but you need only 10 share, means you need only 10 shares, assuming that you are giving 1 shares to one company. So basically 10 members or 10 investors is sufficient. But here what happened, 30 investors are willing to invest in this company. This is the situation will be called as your over subscription. Now the reverse, here you need 10 investors and every investor will invest 100 rupees, but only 5 investors have shown their interest to invest in your company, right? This will be called as your under subscription. Now in case of your under subscription, you will be issuing shares to all the shareholders. But the problem is in case of your over subscription, so you need to allot the shares to the company, right? So there are different ways to allot the shares in case of your over subscription. Now once subscription is there, your allotment is done, then there will be situation, and now you are actually issuing the shares. Now when you will issue the shares, there will be different scenario. The scenario number one is that you are issuing at par. At par means the nominal value or face value of a share is equal to the issue price. For example, the nominal price of a company is 10 rupees and you are issuing at 10 rupees. This will be called as your issuing at par. When the reputation of a company is high, then what happen, you can actually issue the shares at a higher price than the nominal nominal price of the shares. That will be called as your premium. Now what happened, the last one is you are issuing at discount. What happened in case of a discount, when you are issuing the share price below the nominal or face value of the shares, this will be called as your issuing at discount. I'm just giving simple example. What happened in case of par, assuming that the face value of a company or share is 10 rupees. Here what happened, your face value is 10 and issue price is also 10. Done. It will be called as your at par. What happened in case of your premium, you are issuing at your face value is 10 rupees, but you are issuing at 15 rupees. So my issue price is greater than the face value, that will be called as your premium. Now the your issue price is your nominal value of the share is 10, but you are issuing at 8. Now what happened in this case? My nominal value is greater than the issue price, that will be called as a discount. So understanding when means understanding issue at par, premium and discount is important. Okay, so for means just try to understand this concept. It is very important to understand the concept. If you are not able to understand the concept, it will be difficult for you. Okay, so today we have seen the basic of your accounting of share capital. From tomorrow onwards we'll start with this with the concept of means the accounting treatment of share capital. Okay, so if you like the video, please subscribe the channel. Okay, you will get this kind of education content regularly. Thank you.